Niraj Shah, and our guests today are Mrin, Agarwal, and Kshitiz Mahajan. And we're going to be talking three topics predominantly today. We'll address the issue of small cap funds. They've been sold like hotcakes, but they're also falling like dominoes. We'll also talk about what to do with thematic funds, in particular, information technology based funds, simply because they've had a fabulous run over the last 5 years. Is it time to take some money off the table, or is it time to continue riding the horse? And then we wrap it up with a view on credit risk funds. Are they being avoided just because they have the name risk within them? Or is it prudent to not invest in them at the current juncture? Let's start off our conversation. Mrin, I'll start with you, ladies first. Thank you for joining in. It's the first time that we have you on the show. So good having you. What's your view on the carnage that we've seen in the small caps and the mid caps and the subsequent NAV erosion, or if not erosion, a dip that we've seen in some of the small cap funds? Is it a good time to nibble into them, say not in an SIP route, but in a lump sum route? Or would you believe that maybe there is some more to go for this, and therefore investors should buy their time? What should they do?
Well, thank you for having me on the show, Niraj, and nice being here today. I think, we are seeing a very good correction, and we're seeing some fair bit of profit booking, maybe also driven by the BSE circular that came out earlier this week, which limits, which has which has some capping of price movements. I think it's a good thing, because if you see over the last, if you look at YTD, for example, the small cap funds have risen the most and at a very fast pace. So I think a good correction is almost always good. I think we've seen 7.5% correction in the recent past. So I think that's a good correction. I would still say be very careful about which fund you get into. And of course, you must remember that with any small cap fund, your holding needs to be pretty long. So don't get into it looking at some good short-term returns. So of course, do your due diligence, and as long as the holding is long-term, you might want to look at least keeping money ready to start allocating if you see another couple of percentage dip.
But not allocate immediately. It might be good to see it for a bit longer.
Might be good to see, how the whole thing really plays out. I think we had a bit of a recovery today, but might be good to see, because, the uptake has been really high, right? So I think you're looking at 60% plus sort of YTD returns on small cap funds. And again, very typical of people to get into these trending funds. So I think just wait it out a bit more fall, I would say, maybe another 4-5%, and then look at entering in phases.
It is a large institutional mind messaged me that this confirms my theory of how poor retail gets trapped, because mutual fund industry sold the maximum small cap funds last month. My question to you is this: should people who have either bought small cap funds recently or were hoping to buy small caps on any correction use this as an opportunity, or do you believe it's prudent to wait for a bit? Mrin believes it might be prudent to wait. Your view may be different. What is it?
I think Mrin has put it very nicely. My thoughts are that, we are talking about that small cap has rallied in this year calendar, or let's say since last 1.5 years. But if you actually see last 5 years, hardly much of the movement is there. We have seen last carnage in small and mid cap when the regulation on how the funds has to be managed by SEBI was there in 2018. And that year we have seen calendar year negative return for small cap at -57 and your mid cap at -48. So, and I still feel that there can be little more opportunity which this carnage can give you further. But yes, rather than waiting on the sideline, once you start allocating, you already have 5-7% correction on small cap index and mid cap index. That itself is a good discount. And if somebody want to park, let's say 100 rupees on these funds, one will start with 10-20 rupees immediately. So yes, I don't know what is going to be the further discount on the markets, but when you can see that there's a massive discount which has come in last 3-4 days, one can start. Having said that, mid cap otherwise also are trading to a discount to Nifty as on day to day, also close to about 18% discount to Nifty. So one is that you keep on getting some allocation in small and mid cap through your multi cap allocation also. But having said that, if you see 8 to 10 years return on all these indexes, it is in excess of 21-22%. So if you have time on your side, which is in excess of 6-7 years, small cap funds you can invest, irrespective of you want to invest tomorrow or 1 week back. the right strategy is to go slow. Whatever funds you want to invest in, and SIP is the right way. If you have lump sum money, maybe stagger it over next 10 to 12 weeks. That's what one can do.
Kshitiz, so mid caps may be at a discount, but small caps aren't at a discount, right? So I agree that maybe if you look at the last 5 years, small caps may not have done as much, but you have to buy the argument that small caps have been red hot for a while.
Right.
And in a corrective move, the NAVs could be much lower. So I agree that nobody can time the market. I'm just wondering if just looking at the last 2-3 days, would it be better? And again, your answer doesn't have to be a yes. I'm just trying to put you.
So what you're saying is right. Like, the NAVs are not in line with what markets have fallen. Surprisingly, I was just going through a few funds, whether it's Axis small cap, ratios small cap. So, if the small cap has fallen by -6, -7%, NAVs are at -2, -3%. So it might be a possibility that because cash flows are still coming, it's a flavor of, you're right, of last 1 year that people are participating into small cap. There are a lot of SIPs money which is going into small cap. So yes, so one can go slow. So I'm saying I will still say that stick to your asset allocation. We might see some more pain. That is what is more important. If you're underweight on small cap and you want to add, maybe this is the time you can start looking at.
Got it. Okay, so then let me first ask you, Kshitiz, if you are at a liberty to talk about 1 or 2 funds in the small cap side which you believe have done good work and you might be comfortable. The timing is left to the investor,
right.
But the fund, and why do you like it?
So I think a couple of funds, there are 4-5 good funds, but a couple of funds where I personally feel that they are good funds, and I personally feel that they will do little better. Again, this is just my analysis, and there's no recommendation. One is Axis small cap, second is DSP small cap, and third is a Kotak small cap. These are 3 funds, which gives you a very good allocation vis-a-vis. Because as per the regulation, 65% has to be in small cap, and remaining allocation you can take in a mix of large and mid cap basket. So which is a very good allocation on the large cap space also when it comes to the balance allocation. So I like these 3 funds in the basket. Having said that, if you are looking at small cap allocation, my request, we tell people that please come for 5 years in equities. Small cap, should be not less than 6 to 7 years. What? Because there might be instance like 2018 or maybe 2021, we'll see a sharp correction on these indices. So these are my favorites.
I hope these are not the famous last words that 2021 will be like 2018. But Mrin, a quick question to you, because we're running slightly short on time as well. Quick, if you are at a liberty, 1 or 2 funds that you like, they may not necessarily be the only funds, and the timing is not necessarily the question right now. The names of the funds and why you like.
Well, I like DSP small cap. I think it's been a good consistent performer. If you look at the quantitative ratios around it as well, I think this fund has done well, and I like the strategy that they have. So I would go with DSP small cap.
Okay, viewers, please follow please use discretion if you will. I know some of you come to the show because you don't have a financial advisor and you depend on these guests. So their recommendations are very welcome. But yeah, please do your own checks as well. Now, Kshitiz, the second piece I'd like to start off with you. And that is on, it's not necessarily thematic funds, but when I was looking at funds which have done really well over the last 5 years, some of the best ones were IT dominated funds. There was also quant small cap, but aside of that, it was all IT, right? And yes, IT funds have done really well in the last 5 years. Is it time to take the foot off the pedal, take some chips off the table, maybe redeploy that money elsewhere, or you're comfortable staying invested in an IT fund?
So, Niraj, just to give perspective on IT as a sector, if you actually compare broader index, let's say Nifty with S&P 500 of US, just apples to apple, IT allocation, I'm not talking about NASDAQ, I'm talking about S&P 500, let's say any European emerged economy. Apple to apples, IT allocation or technology allocation is close to about 27%. We are at 14.5%, 15%. So one is that we are still underweight on technology on an index basis also. Second, last 1 year has been very clear that Indian companies, technology companies, have proved to the world that they can work remotely and they can manage things from here. And we have a long runway in front of us. I have just done one analysis on the AI part, wherein I have personally evaluated 10, 12 companies which are going to go places on the technology platform. I'm not here to give any recommendation on the stocks, but I'm saying that no ways one should actually start adding little more allocation towards IT. Again, when I say technology fund has done well, and they will keep on doing well, but whenever you want to allocate in a lump sum way also, just stagger it over next 10 to 12 weeks. That's what you can look at doing. So I think technology is the future, and in that there are a lot of good offerings in India right now, which are available.
Okay, so forget taking money off the table. Kshitiz is recommending that if you don't have one, please add it, and even if you have it, add some more to it. Right, Kshitiz?
Right.
Great. Mrin, what are your views here? And they could be different from Kshitiz, of course.
Well, I do also agree that the technology sector is certainly looking very good. But as such, I do not believe in investing in sector or thematic funds. I think these funds are meant really for more advanced investors who are taking tactical bets in these particular sectors and who understand the risks that are associated with investing into a sector fund. Because in any sector fund, you are going to have a concentration risk. And, even when you look within the IT fund space, you will see that the top 10 stocks constitute to about 65 to 75% of the fund. So to that extent, these funds are highly, highly concentrated, which means high risk. So clearly it's investors who are wanting to take a tactical bet into these funds who need to, get into them. And of course, that there is sector rotation, and some years some sectors do well, and other years other sectors do well. So obviously you need to time your entry and exit to that extent. And I would say that if you're already holding a fund and you understand the risks associated and you're okay with the volatility, hold on. But I would actually recommend that for others who want to take exposure to this sector, and not as a tactical bet, maybe they could actually just go with the broad-based flexi cap funds, because those funds also have about 7 to 15% exposure to the IT sector, and pretty much similar stocks that you would see in the top 10 within these funds. And you could also look at some of the flexi cap funds also have a lot of foreign stocks on the IT side as well.
Okay, so viewers, Mrin is a bit conservative in that she doesn't recommend thematic funds at large, and therefore she's not in favor of even IT funds investing. If you follow that psyche, do follow Mrin's advice. Maybe look at flexi cap funds. If you are comfortable investing in thematic funds, then follow Kshitiz's advice. He believes we should add into them. Kshitiz, very quickly, one quick follow-up to that. Therefore, when I looked at the top performing funds amongst the names that were there, the ICICI Prudential Arihant Tech Fund, the Tata Digital India Fund, Aditya Birla Sun Life Digital Fund, SBI Tech Opportunity Fund. These are amongst the top performers across. You recommend one of these, or do you like some other fund? Very quickly.
So I like Tata Digital, and I like SBI technology fund. And the obvious reason is, one is I like both the fund managers, their strategy. Second is they have on a domestic platform only given allocation towards international equities also, and they can go up to 20-25% international equities. Like Tata Digital right now have 6%, but they are planning to increase it to 20%. So it gives you a benefit vis-a-vis the taxation part also, because I know there are a lot of funds which offers you fund of fund option, and there are also good funds which they can allocate to US and other technology companies. But again, you get domestic taxation in these companies. Second, SBI has 15%, and it has the likes of your Microsoft, it has Alphabet, it has Nvidia. So there are companies which can do well. And I was talking to Srinivasan, and he was saying that we will take this up to 25%, because eventually we need to maintain 65% domestic equities. So I very strongly feel that it's not a cyclical, or it's not a fund where you have a rotation, especially healthcare and technology, both funds. Because in the long term, if you see, let's say 15-16 year track record, you see this fund right now the returns are looking fantastically well, but otherwise also these funds have done well. So I think for a broader allocation, one can look at, and obviously what Mrin is saying is right, that you have to decide on your risk appetite, what it is, and what type of asset allocation you're looking at.
Okay. Last 3 minutes on the show, Mrin, the final piece on the show, and that is credit risk funds. The first 1.5 minutes to you, and then the last to Kshitiz. Credit risk funds. Should people take exposure to them? Are they bad-mouthed for a wrong reason?
Yes. So I think, the entire sector has this whole overhang of what happened in 2020. Within the sector also, there are funds that have actually done well, that have not had defaults. But again, it comes down to your risk profile. So you should understand, the investor should understand that these funds are going to buy primarily bonds which are rated below AA, which means that they are going to be high risk in nature, and they need to be ready for that sort of volatility. So you can get into a credit risk fund provided you have a 5-year time frame. And when you are getting into this fund, look at how is this fund managed defaults in the past. Of course, the good thing that's happened out of everything that happened last year was that due to the newer regulations that came in, a lot of funds cleaned up, and maybe they're better geared now to manage credit and liquidity risk. So check the liquidity, check the credit profile, check the fund manager's experience in managing defaults. And very importantly, of course, modified duration, because at this point, you don't want to get into a fund that has got a very high modified duration.
Okay, Kshitiz, what about you?
So, I'll just add to what Mrin said, and I'll give in these 3 steps. Number 1, obviously, depending on your risk appetite, look at adding up to 8 to 10% of your data allocation in a credit risk fund. Second, do a level 2 check on the papers which it's holding. Let's say the funds which we normally look at, they are having 45 to 50% in government bonds or, let's say, liquid papers. Third, go level 2 on AA side also. You can see that what type of house companies are there. Like, say, if a Tata Group company is there, or let's say if a company which is backed by gold or some other good business houses are there, chances for default might be little less vis-a-vis other companies. And another thing, if your investment horizon is in line with what you call your modified duration of the, or let's average maturity of the paper of the fund, then things become much easy. So ride is not going to be that smooth like a banking and PSU debt fund. Having said that, there is a spread of 125 to 150 bips vis-a-vis banking and PSU debt fund.
So what's the return, Kshitiz, that one can expect?
Anything which is pre-tax close to about 6%, and when you're holding for 3 years, it's a long-term 20% with indexation. So you can actually look at close to about 6%, 5.75 to 6% is what one can look at.
Yeah, credit
and if you get lucky, if you get some mark-to-market gain, that's a separate.
Got it. Okay, Mrin, similar question to you. And any credit risk fund that you are comfortable, that you believe is safe? Mrin, quick 30 seconds.
I wouldn't use the word safe for any credit risk fund, but I'll say
relatively
this fund, and I'll also give a disclaimer that I've invested in this fund for a very long period myself. So I would say ICICI credit risk fund. It's not had any history of default. Modified duration, I think currently is about 2.5 or similar to that. Not very concentrated in terms of holdings, right? So I think that's a good fund to go with.
Which is why I use the term relatively. But out of time completely. Mrin, Kshitiz, thank you so much, both of you, for joining us today on the Mutual Fund Show and giving us some very important pieces of advice. Really good having you.
Thank you.
Viewers, thanks for tuning in to this broadcast.